Good day and welcome to class. My name is Ifeoluwa Adedeji and I'm the accounting tutor. Today we'll be taking one of the most important topics in accounting for JAMB and for other examinations, and that is bank reconciliation statement. By the end of this class today, you'll have understood what bank statement is, also what cash book is, also what bank alert is all about. You have understood the reasons for discrepancies, or differences between the bank statement and cash book balance. We will also treat the accounts that can be used to settle the discrepancies, and we'll be taking likely questions that can be asked in JAMB. So let's start.
Hi everyone, welcome back to another Disruptors Educational Special. Here, we make learning easy. Please don't forget to like, subscribe, and ask questions. Let's get into class. Hola!
For us to understand bank reconciliation statement very well, there's need for you to know what a bank statement is all about, because there are two important things, in this thing, which are the bank statement and the cash book. You know, as you all know, that in accounting deals with financial transactions. And you will know that in one of our classes, if you have seen one of our videos, one of our classes when I did introduction to accounting, I taught us that financial statement transactions can either be cash or check, or it can either be credit. Now, if it is cash, that means money has been used or money has been paid. Either cash, and in accounting it is called cash in hand. While anytime you see the word check means bank, which means cash at bank. So today now it deals with situation whereby an individual who has what we call the cash book, and cash book has been said to be a book of original entry for the record of cash and check transactions. And cash book, like we all know, is an asset, and all assets must have a debit entry. Now, also, your bank also is an asset. Now, a situation whereby you have, take for example, you have an amount in your bank that reads 5,000 naira. By the time they send you the bank alert at the end of the month, you have 5,000 naira. But meanwhile, in your mind, you believe, or your own calculation, you feel you should have 6,000 naira. That is what we call the discrepancies. Now, the difference between, whereby you have a difference between the cash balance and the bank balance. That's what we talk about the discrepancies. And now, what is a bank statement? Now, a bank statement is a records of a transaction with your financial institution. It's just a comprehensive analysis that shows the inflow of cash and the outflow of cash in your bank account. And like we all know that anytime we withdraw from our bank, you will be told that you have been debited, which means your account has paid out. While anytime money is received in your account, you hear the word you have been credited, which means money has been paid into your account. So now what bank statement does is it helps to show the records of the inflow of cash into your bank, which is payment made into your bank and your bank account, and also the outflow of cash, which means when payment is being made from your bank account. That's what a bank statement is. So I come again, a bank statement is the record of a transaction with the bank that shows your inflow and outflow of cash. I believe you are following me. So let's continue. Why cash book? Now, before I continue, bank statement represents your transaction with a bank. Why cash book? Like I said it is a book of original entry that is used to record all cash and check transactions. So it just shows you're dealing with the outsider, money spent or money received. And you know that cash book used to have debit side and credit side. The debit side, I believe you can see me, the debit side is used for receipt, which is money received, while the credit side is used for payment, which are money spent or money paid out. So that is what the cash book is about. So a cash book is opened by an individual. Are you following me, please? Now, situation whereby, let's assume that in your bank statement you have 25,000 naira. While in your cash book is showing 23,000 naira. I believe that my viewers, my students at home, I believe that you have seen a situation whereby for those of us that have a bank account, whereby at the end of the month, where you ask for your bank statement, for example, you press star, whatever, and they give you a bank statement, and you feel or you think you should have 25,000 naira or 23,000 naira, and they send you an alert of 25,000 naira. Okay, something happened to me one time. I went to the bank to order for the ATM, and they deduct an amount of money in my account, but that deduction has not reflected already yet in my bank account. So something like that is what we call the discrepancies. So they will now talk about what is a bank alert. Now, these are the things that will be asked in your JAMB questions. JAMB will ask something that has to do with the bank statement. Like I told you, it's a record of your transaction with the bank that shows the inflow and outflow of cash. This year, this is the outflow of cash. This is the inflow of cash. This is called payment made out of the account. This is called payment made into your account. That's why you used to hear the word credited and debited. Then let's continue. Now, what is the bank alert? A bank alert is just a periodic statement sent by your bank to their customer. It's a periodic statement sent by the bank to the customer to show the transaction within a given period. So now there are important things that are there. It is sent by the bank to the customer to show periodic financial transactions. So it is just an alert that comes to you, either your phone or whatever, that shows how money has been spent and how money has been received in your account. So let's continue. Now, I was saying something about this bank reconciliation statement. The word reconciliation means to settle a disagreement, to settle a discrepancy. That's what this thing means. So now, a bank reconciliation statement is just a document that is prepared and is used to reconcile the difference between the cash book and the bank statement. It is used to reconcile the difference between this cash book, which is the receipt and payment, the balance of the cash book, either on the credit side. Normally, this is how your cash book look like. You have something like this. Here you will have your opening. Then all receipts will be here. Then all payment made will be here. Then your balance CD will be here. So then you balance it up. Now, if here on the credit side here, you have a balance that shows 23,000, but your bank is sending you an alert that shows 25,000. When there is such discrepancy, the kind of statement that is prepared by the bank to settle such is called a bank reconciliation statement. So I call again, it is prepared to settle disagreement between the cash book balance and the bank statement balance. Can we continue, please? Please just follow me as I continue. Now, what are the things that can cause differences? What can make you have 23,000 naira here and 25,000 naira in your bank account? So I will be listing them one after the other. I will show you, I will mention the meaning, I will tell you the effect, and I will tell you the collection. Those are the important things you have to understand when preparing your bank statement. And now, JAMB questions will be coming from either the meaning, JAMB questions will be coming from the effect, JAMB questions will be coming from the collection, JAMB questions will be coming from the posting. and by the grace of God, we will do those ones today. So let's start now. Now for the differences, I believe you can see me. The first one, what we call the unpresented checks. A check has been defined as an unconditional or conditional written order by an account holder to the bank for payment to be made. Now, that's what a check is. Now, the word unpresented checks, they are checks that have been written in favor of an individual by an account holder, but such check has not been paid into the bank. Are you following me now? Now, I have an account, let's say with so and so bank, and I have their check leaflet, and I've written out a specific amount, say 2,000 naira, in favor of anybody. And the person should go to the account, to the bank, and collect such money. But such check has not been presented. Those are one of the things that can cause discrepancy. And the these are the things you have to understand. The effect of this is that it will cause a greater bank balance and a lesser cash balance. These are the important things you have to understand. The effect of this is it will cause, because the amount has not been presented in the bank. So in your mind, you feel, okay, I have 23,000 naira. I've written a check of 3,000 naira. That means I have 20,000. That's that. So it will cause, so the bank statement balance will be higher than the cash book balance. Now, for the correction, to correct this, you will add to the cash book balance and subtract from the bank statement balance. As we continue, we'll show the format. There are two ways by which this is prepared. It's either you prepare it as balance as per adjusted cash book or balance as per bank statement. So if you are starting with balance as per adjusted cash book, you will add up. If you are starting with bank statement, you will subtract. So let's continue. Now, number 2, we have got the uncredited checks. Now, this one, unpresented check, it is a check that is written in favor of payment to be made. This one is a check that was received by an account holder to be withdrawn from the bank. Now, this one now, they've already given you. You're supposed to go to the bank to go and withdraw or cash out such amount, but you have not gone to the bank. So the effect is, it will cause a greater cash balance and a lesser bank statement balance. That will be the effect. Then the correction will be add to bank statement, deduct from the cash balance. That's another thing that can cause it. Number 3 that we have, that we call dividends. Now, dividend, like we all know, dividend is the returns or the yield on investment. I believe you all know that. So if a person has called a shareholder has invested his money into a particular company, at the end of the month or at the end of the year, such person will be expecting a return. Such return is called dividend. Now, this dividend can be paid in 2 ways. There are ways by which you can be asked questions in JAMB. They can tell you dividend deposited in the bank account. When such statement is made, when it is made into the bank account of such shareholder, the effect will be, it will cause a greater bank balance and a lesser cash balance when such is made into the bank account. Now, to correct it, now what you just do is just look at anything that has to do with this kind of thing. You have something like this there. What you have to do is you add to the cash book and less add to the cash book and less from the bank statement. But if they said dividend was deposited by cash, they said dividend was deposited by cash to the shareholder, such in that situation it will cause a greater cash balance and a lesser bank statement balance. If it was made by cash to the shareholder, it will cause a greater cash balance and a lesser bank statement. So just to do that, you make the correction the other way around. Another thing that can cause it, what we call dishonor check. This is a check that has dishonored check. For better view, let me bring it up here. I believe we've gotten the ones that I have to clean. Now, another thing that can cause it is what we call dishonored checks. You know, questions can be asked on this thing. They can ask you something on the definition of dishonor check. They can ask you something on reasons for dishonor check and the treatment and the effects. Now, dishonor checks are checks that have been received by the bank. Dishonor checks are checks that have been received by the bank, but later returned back to the customer. It has been received by the bank for payment. You know, if you go to the counter, you've drawn your check already. You give it to the person there. The person have already checked all those things. The person now returning it back to you. That will call dishonor check. So it has already been initially received by the bank, but later returned back. And there are reasons why checks can be dishonored. Number one, we have mutilation. Number two, we have wrong signature. Number three, we have irregular signature. Number four, we have difference in amounts and different amounts in words and amounts in figures. We have other things that can make bank return your check back to you. Now, when such is done, the effect of the dishonor check is it will cause a greater bank balance and a lesser cash balance. Now, to correct it, correction, add to the cash book and less from the bank statement. Another one we have what we call credit transfer. We have what we call the credit transfer. Now, credit transfer is simply put as a situation whereby payment is made into your account without your notification. You know, somebody that was initially owing you has paid you, but the person did not tell you that such payment has been made. So what will cause it? It will cause your bank statement to be higher than your cash balance. So the correction too will be like this. Another thing that can cause it is that we have what we call direct debit. Direct debit. Direct debit. It is when deduction has been made from your account without your notification. You know, you are owing, let's say you are owing your supplier. You know, direct debit is what we call, these days now, it is now called transfer. When I tell you that, okay, let me pay something and say, okay, let me transfer, it's called direct debit. Are you following me now? But in such a situation, if such has been made and you don't know, that's another thing. I believe you're following me. Another thing is interest. When interest is paid into your account, interest is paid into your account without your notification. Another one that we have is standing order. Let me clean this for better view. Another that we have is what we call standing order. Standing order is an authorization given by a customer to the bank to make payment on his behalf on a given day. So if you have told your bank to be deducting one particular amount from you every month, maybe for cooperative, for social security, for student payments, for utility bills, all these DSTV, GoTV, all those electricity bills and the like, water bills, is called standing order. We also call bank charges, among others. Other things that can cause it are overstatement of the cash book, understatement of the cash book, and so on and so forth. Now, these are the effects are those things that can cause discrepancy between the cash book balance and the bank statement balance. Now, before we move on to the settlement and treatment of it, now let me ask you a question. Let me ask you a question. How is now, you know, I did not give you intentionally, I didn't give you the effect and the correction of bank charges and standing order. I want to see it in the comment section. What will be the effect of standing order? What will be the effect of bank charges? That is one. That's one question. Another question is, you know, another error that can cause it is called bank errors. That can cause discrepancy. Bank errors. So I want you to tell me what is the difference between errors and mistake. That we call bank errors. That's, you know, I told you question number one. What will be the effect and correction of standing order and bank charges? Question number two is what's the difference between errors and mistake? Then we'll continue with the next class.
Thank you for watching. See you in our next class. Do have a wonderful day. Please don't forget to like, subscribe, and share with your friends. Bye-bye.